morning, everyone. My name is Rachel Carruthers, and I'm the Director of Communications and Events here at the Portland Regional Chamber of Commerce. Welcome to Growth Basics for Business, a monthly breakfast seminar series which provides a forum to gain useful do-it-yourself workplace solutions and insightful, actionable tips. Today is our first event in the 25-26 season of Growth Basics for Business, and I want to thank all of you for joining us this morning. This morning's topic, How Small Business Owners Should Interpret Their Books, is presented by Steve Bazant, Managing Partner, and Veronica Kyrgos, Project Lead at Webster Pacific. Today, you'll learn how to empower your small business with basic financial analysis. Today's session teaches small business owners how to interpret key reports from their accounting software, enabling clearer insights and smarter decision-making. Steve and Veronica will cover financial report fundamentals, conduct live spreadsheet analysis of the profit and loss and balance sheet, and review cash management techniques. Like all of the Chamber's virtual signature events, today's presentation is free and is being recorded. It will be made available for free replay on the Chamber's website and YouTube page. To keep up to date on all the Chamber's news and events, visit our website, portlandregion.com. Check out our events page while you're there and follow us on Facebook, Instagram, and LinkedIn. You can also sign up for our weekly email newsletter while you're there. Before we begin today's program, I want to remind everyone that we're using a platform called StreamYard. This platform provides improved production and interactive elements that truly enhance our virtual events here at the Chamber. On that note, I'd like to point out that when you have questions for our presenters today, you can type them in the YouTube chat throughout the presentation. Steve and Veronica will answer them when appropriate during their training, and we'll also reserve a little bit of time at the end of their presentation for Q&A with everyone here if we don't get to your questions during the program. That is the long way of saying please do interact with us this morning and ask questions through the YouTube chat. Now, I don't want to take any more time away from the program. Plus, I think everyone has certainly heard enough from me this morning. So with that, I will hand things over to Steve and Veronica. Steve, Veronica, take it away.
All right. Hello, everyone. Thank you, Rachel. Thank you, Riley. And thanks to the Portland Chamber for letting us speak today. We are here to talk about a very exciting topic, how small business owners should interpret their books. So let's dive in. Okay. All right, first off, who the heck are we? I'm Steve. I run Webster Pacific. I've been a fractional CFO for 10 different small businesses, mostly in the $1 to $50 million in revenues range. And I've worked with 30 different businesses on strategic growth.
Hi, I'm Veronica. I'm a project lead at Webster Pacific. I oversee the bookkeeping practice at our firm, and I also lead 5 clients in strategic finance.
Okay. So quick little bit about our firm. We are a 12-person consulting firm, and our new super exciting tagline is we help small business owners turn complexity to clarity. So we do a lot of work in finance. We do some bookkeeping ourselves, operational work, a lot of in inventory. We do growth analytics, sales strategy, things like that. And then technology, kind of thorny ERP migrations, data warehouses, that sort of thing. So a keynote is that our clients are not interested in just doing the status quo. They want to grow their sales, increase profits, streamline their business. If you've been doing the same thing for a long time and that's working and you don't want to change it, great. But that's not for us. Our clients need to be interested in making decisions with data too. Okay. So let's get rolling here. Veronica?
All right, so please share your questions and thoughts throughout the presentation. We know that bookkeeping is not the most riveting of topics, so if you could help us out. And,
not that bad.
And you can just put things in the chat, and we'll have Rachel here to help us with that as well.
Okay.
So books do vary significantly by industry. So just to open this back up to you guys as well, if you could send in what industry you're a part of, that would be great as well.
Okay. So roadmap for today, we're going to start off with a little scope, a little purpose here. We're going to set some foundations, some basic foundations. And then we're going to get into the interesting stuff. We're going to take an income statement and a balance sheet in a raw and messy form, likely out of QuickBooks or pick your accounting software. We're going to put it into Excel, and we're going to start interacting with it and analyzing it. And then hopefully we'll have some time at the end, and we'll talk a little bit about cash management. Okay, let's set the stage, Veronica.
All right, so today's presentation is designed specifically for you. So for small business owners who have a basic understanding of fundamental bookkeeping and financial statements. And our primary goal is to take your understanding to the next level. So the way we're going to do this is we're going to start with a quick refresher of the basic financial statements. Think of it as like a quick warm up to make sure that we're all on the same page. And then we're going to dive into some simple but powerful analysis tools for both your profit and loss statement and the balance sheet. These aren't complicated formulas. They're practical ways to read between the lines and gain insights into your business's health. So we're going to look at things like trends and key ratios that can tell you a lot more than just the bottom line. And then finally, we're going to have a focused discussion on cash. As many of you know, cash is the lifeblood of any business. And so understanding its flow is critical. So we're going to explore why a profitable business can still run out of cash and what you can do to manage it better. By the end of this, you should have a clear picture of the tools that you can use to make smart decisions for your business's future. So why do we even bother with all this bookkeeping, right? What's the point? It really boils down to three main purposes. First is to operate your business effectively. So this is the day-to-day stuff. Without good bookkeeping, you wouldn't know who owes you money, who you need to pay, or how much you have in the bank. So it's essentially the engine that keeps your business running smoothly. The second is to pay your taxes. No one loves paying taxes, but we all know it's a necessary part of doing business.
Rachel, let's do another poll. Who loves paying their taxes? Who does their books just so they can pay their taxes?
Right. Good bookkeeping makes this process so much easier is the main point, though, because when tax season rolls around, you won't be scrambling to find receipts and invoices. You'll have all the information your CPA needs right at their fingertips, which is going to save you time and money. And finally, and arguably the most important purpose, is to help you reach your financial goals. And that's what we're going to be focusing on today. The key thing that I want to highlight here is like bookkeeping is not just a record of the past. It can be a tool for the future. So by accurately tracking your numbers, you can understand what's working and what's not. And that data will help you make smarter decisions.
Okay, foundations. So likely people joining are at a spectrum of bookkeeping understanding. Hopefully we don't have any CPAs here, really double, triple checking our stuff, but I'm sure we have some people who are very experienced in finance and well-versed, and some of those that are fairly new. So for those very experienced, we're going to try and get through this section quickly, but we just want to talk about the basics and the fundamentals first. So we've got the three common financial statements here: the income statement, the balance sheet, and the cash flows. And I like to think about it in terms of time and period, and also the basic formula. That's how I wrap my head around from the most basic understanding of these statements. So time is important and different for each of these statements here. So the income statement is over a period. You can only run an income statement over a time period. So a day, a week, a month, a year. Balance sheet is a snapshot. So you can only run it at an instantaneous point of time. Usually we'll run it in our books on the last day of the month, the last day of the year, but it technically can be run down to a millisecond. And then cash flows is like the income statement, it's over a period. So for those very new, I'm going to tie this back into just some basic personal financial examples. The income statement is going to be like getting your paycheck. So you don't get paid in a second. At a given second, you don't know your pay, but you know how much you get paid over a month. You know how much you get paid over a year. In terms of expenses, also on the income statement, you likely know how much you pay at Dunkin' Donuts or Starbucks. once a week, once a month, but it's not down to the second. The balance sheet, an example, is your bank account. So when you open up your bank account or you go to your statement, you see exactly how many dollars and cents you have in your bank account at that exact time. If you're a business, you have inventory, you count your inventory and you know how much inventory you have right then. And cash flows is back to the income statement. It's a period. Okay. So now let's talk formula. If you don't have these memorized, get some flashcards, because these are good to just commit and be able to rip off and remember quickly. So for the income statement, revenues minus your cost of goods sold minus your overhead is your profit in layman's terms. Okay. And your balance sheet by name has to balance. It is a balance between your assets equaling your liabilities and your equity. And then in cash flows, it's a bit of a mouthful, but your net cash flow at the bottom there is your operating plus your investing plus your financing cash. Okay. And these will start to make more sense as we get into the nitty gritty and really look at some examples, but just want to set the stage here.
Okay.
Veronica?
Cash versus accrual. So cash accounting is very simple. It's essentially your bank account. So your revenue is recorded when the cash is received, and the expenses are recording when the cash leaves your bank account. Accrual accounting relies more on the matching principle, which is it matches the expenses to the revenue they help generate. So I'm going to give a specific example now. Let's imagine you sell homemade cookies. Okay. Let's say you buy the ingredients for the cookies in January. You bake the cookies and you sell them and put an invoice in February. And then your payment for the cookies comes in March. So in cash accounting, what this would look like is we would have in January the big expense for the ingredients, and we'd show a big loss. And then in March, we'd show a massive profit for the cookies for the cash that was received from selling the cookies. Instead, in accrual, when you buy $100 of ingredients in January, because you aren't selling those cookies yet, it's not yet an expense. That's just inventory. In February, when you've invoiced those cookies, that's when you recognize the revenue on your income statement. And since you're recognizing the revenue in February, you would also recognize the cost of the ingredients in February as well. So you would show if it's $100 for ingredients and $300 for the cookies, you'd show a $200 profit in February. Essentially, this approach, the accrual accounting approach, smooths out your gross margin because both the revenue and the associated expenses are recorded in the same period. And this is going to be a much more accurate representation of how your business is doing.
And we're not going to get into tax much today, but it is tangential to bookkeeping. And we talked a little bit about it before, but based on different tax requirements, you may be required to run accrual or some version of accrual. Many businesses, especially large businesses that have inventory, need to run accrual because if you didn't, then at the end of the year, if you were showing a lot of profits, you just buy a bunch of inventory, show a lot of expense, and then you'd have no profits to pay tax on, right? So some of these are requirements that we need to follow. Okay.
All right, chart of accounts. So a well-structured chart of accounts is the backbone of your financial statement because it's going to directly impact your ability to understand and manage and grow your business. I like to think of it as a filing system for all of your company's financial transactions. So just like a messy file cabinet makes it hard to find a specific document, a poorly designed chart of accounts makes it difficult to get accurate and useful information.
Yeah.
So the example that we have here is very specific. I would say, let's imagine that this is an outsourced personal assistant consulting company or something. So most of their costs are in their office supplies. On the far left,
It was like Dunder Mifflin.
Exactly. So on the far left, we have too many chart of accounts. So while detail seems good, it's actually a problem. Like this will become a nightmare very quickly to manage. It's just going to make the financial statements super cluttered and hard to read. You don't need to know how many red pencils you have that are long versus short versus uncapped. That's not a level of granularity that's going to be helpful for you. On the far right, though, we have too little and vague. So while this is simple, it's really not helpful. You're not going to look at these chart of accounts and get a concrete idea of maybe where you're spending too much money. Just right is at the bottom. So this approach gives you a clear and useful picture. You can see that you spent $200, for example, on paper this month and $50 on ink. And maybe that you realize we're spending way too much money on paper. We need to look into potentially investing in software and moving away from physical record keeping. So what I will say, the caveat is here, is that it really does depend on the size of the historical amounts. So if you're buying 4 pieces of paper a year, then you probably don't need the granularity, and that paper products chart of that account would be completely gone, and we put that into other. So it does depend on the history of those transactions and how large the amount of money is that you're spending on each of the accounts.
Okay. All right. Who's seen this meme before? It's kind of a silly one. All the Spider-Men pointing at each other. But there's an important piece about team alignment here. Bookkeeping cannot be successful with just a good bookkeeper. It takes a team, okay? And so what happens sometimes is that you get this finger pointing that goes on, right? So the owner may say, my books aren't good. They're not getting closed on time. My chart of accounts is totally messy. It's my bookkeeper's fault. And then you go ask the bookkeeper and you say, hey, what's going on? And the bookkeeper says, well, I reach out to the owner on the 3rd day after the end of the month, and I send them all the uncategorized transactions, and I don't hear anything from them for 4 weeks. And also, I never get FaceTime with them, and so I don't know how to categorize these different transactions, or how I should make the books reflect the business. And then the operators, let's take an example of inventory or something that's complex for bookkeeping. For the bookkeeper to do a good job tracking what inventory has landed, what inventory is in transit, which POs you paid deposits on, which are closed out. There needs to be a great system on the back end so that they can translate what the operational people in the business know to the books. And unless the owner, the bookkeeper, the operators, unless everyone's working in concert with each other, then you get bad books, right? And it's easy at that point to start pointing fingers. And so the key here is to bring everyone together, right? We want to voice each of those concerns that I just brought up together and work out a process. Many times it's creating a simple checklist at the end of the month, identifying which activities happen X number of days after the month close. And then everyone hits their deadlines, and lo and behold, you'll improve your closing process, include the accuracy and the effectiveness of your books. Okay?
Right. The checklist should include a column that says responsible so that you have the name of the person who needs to do it as well.
Yes. Okay. Veronica? All
right. So question, does your business do financial analysis? The options here are no, some, or yes, but also you can answer and say what kind of financial analysis you do and on what statements, if you're looking mostly at your cash, if you're looking at your income statement, if you're looking at your balance sheet metrics. Feel free to share. And then Rachel, if you could pop in and let us know if anybody shares something we can and comment on it.
All right. Okay, now let's get to the fun stuff. So income statement, also known as the profit and loss. We're going to get into some nitty gritty here, and we're going to download the statement. Okay. We have a totally redacted version. It may not make perfect sense. It's not supposed to. It's a fake business. But imagine that we're going to your financial software. Let's say QuickBooks is a really common one. Let's say QuickBooks Online. Go navigate to the report section, find the income statement, set your time period. We like to pull multi-year. More data is generally better. You can group it and hide it later. Choose monthly. You may want to start with an annual, bigger picture, but we like to pull by month because then in your analysis tool, maybe Excel, you can group that up. And then check accrual versus cash, right? If you're keeping accrual books, go ahead and flip that on and download the statement. So when we do that, we're going to get some very raw and somewhat overwhelming data that Veronica's about to share, but we're going to go ahead and do some basic analysis on it together today. We're going to start by just making sure we understand the rows. We're going to do and talk about what cleanup may look like so that you can make the chart of accounts work for you, that Goldilocks slide that Veronica was showing earlier. We're going to talk about some basic percentages that are common in finance, so gross margin and profit margin. And then we're going to get into some summary analytics, looking at a ratio analysis, some month over month or year over year. And then we may even, if we have time, look at some seasonality and get to some KPIs. Okay. So Riley, could we flip over to the Excel doc here? We'll dig in. Okay. So I'm going to move this over to my big screen. So sorry if I'm looking away, but I can get a little bit more view here. So this is what the income statement might look like when you pull it out of QuickBooks or whatever your financial software is. Kind of yuck. I mean, there's a bunch of different, how many rows are in here? And we try and look and digest this. Oh, you can just scroll to the bottom. It's okay. We've got almost 100 different rows. It's totally an eye chart. A bunch of zeros are showing. I set us up for failure a little bit. There's a ton of columns. It's so much to look at. So let's talk a little bit about cleaning this up and what that may look like. Veronica's going to do some basic analysis just in Excel together here. And then we do have a more polished version that we've already done a little bit of the work on in a different slide. And so then we'll flip over there and start talking about interpreting the books and what we can learn about our business with the purpose of being, what decisions are we going to make differently by doing this analysis? If we don't make a decision differently, then a lot of times it's not really worth our time. So what Veronica's doing here is just creating an annual summary. So she's grabbing and just doing a very basic sum formula of 2024 and 2025 YTD stands for year to date. And she's going ahead and just pulling these formulas down. One way to do this is in Excel. Another way to do it is in the financial software. There are some fairly robust reporting tools. So let's say you have an experienced bookkeeper or you're experienced in the software yourself. You may want to just go into QuickBooks and say, hey, I want to, this is how I like to review my reports. And I want to make sure that I always have totals, year to dates, percentage of totals. I want a basic ratio analysis. And then that report will be there every month for you. Today, we're just doing it here because it's a little bit more flexible and I think approachable. Okay, so Veronica's gone ahead and added our summaries here, the annual summaries. And let's go and just look at the data. We're looking at a business that's, let's see, for income, they're selling, okay, some Shopify sales. So this is likely a business that sells direct to consumer. But then we also see some department stores. Okay, so maybe they're also doing some wholesale. This could be a business that's selling accessories. This could be a business selling swimwear. So let's see what they're doing in sales. So in 2024, Veronica, could you give another couple clicks in?
Yes. And one quick moment, somebody did ask, they said, how often should you do financial analysis?
Oh, great question. It depends on the financial analysis. So for example, we're going to talk about product margins in a little bit. Product margins are looking at how much you charge or how much you collect for selling a given product versus how much it costs you. Generally, unless you're in a very, very dynamic and fast-changing industry, your costs don't change overnight in a material fashion. So something like that, a product margins analysis, you might be doing once a quarter. It might be a couple of times a year. So that would be a longer period. Financial analysis for budgeting, so setting a longer term goal. That's something you may reforecast on a monthly basis, maybe, but more likely you're reforecasting it once a year and doing the budget maybe once or twice a year, especially for a small business. For doing this basic income statement analysis and looking at the ratio, I'd look at this once a month. I mean, if you see that your payroll cost has tripled month over month, and that doesn't reflect the reality of the business, at least as you understand it, that's something you want to catch up on, right? You'll likely see that your bank balance has changed significantly. That's probably what people are monitoring very, very closely, especially in a small business. But yeah, so that was a long-winded answer of what we're doing today. I would do once a month. I think it's a good practice to look at your books once a month and do some light analysis on it. Veronica, do you agree?
Absolutely. Yeah.
Okay. Okay. So we've added some totals in there, and we just started talking a little bit about the business. We see 5.3 million total income in 2024, with 2.7 million of cost of goods. Mostly looks like probably the inventory, if this is an inventory related business, and you can see some shipping and some fulfillment. So Veronica's going here and putting in what's called a gross margin percentage. And so gross profit percentage. So this is your total income minus your cost of goods sold divided by your total income. And this shows the incremental contribution to cover your overhead based on your revenues and your costs. So we really like to monitor this number closely. As you can see here, based on what Veronica is showing, from 2024 as a whole to year-to-date 2025, there has been some erosion in gross margin. And that could mean that costs have gone up. It could mean that you are discounting more. It could mean that if you sell through a channel that has a lower margin than a different sales channel, it could be that your sales mix is changing. And so you want to really be aware of that as a business owner, how the business is changing. And so starting with these larger percentages can give you an idea of where to start looking to diagnose the problem. Okay. So Veronica, you could also run this by month, right? You could take that percentage and just run it
Absolutely.
by month. And if you run a cash business, if you run your books on cash, this will be all over the place. This will be up and down and up and down and up and down. And one, I think, compelling reason to run accrual books is so that your gross margin isn't all over the place. So that if you do see an increase in costs or a drop in the price that you're selling your product for, that you catch that sooner rather than later. Okay. So looking back historically here, the gross margin has been fairly uniform by month, except for January. And yeah, I guess in the end of Q4 of 2024, that could be, that's a typical holiday selling period. And that could be the explanation of that. So let's keep going here. And I want to make sure we're keeping our eye on the clock. So let's go ahead and do a little ratio analysis. So ratio analysis can be run in a few different ways, but I think the simplest way is to just take each row that's in the income statement and divide it by the total income. And so Veronica is going to go ahead and do that here. So she's going to do equals in Excel, that cell AG8 divided by AG20, the total income, and freeze that. And she's going to start dragging these down. Okay. All right. And so while she's doing that, just at the, oh yeah, go ahead.
Sorry.
No, it's fine. At some point, we'll just flip over to the more polished presentation. Okay, so let's take discounts. So right now, row 10, discounts. In 2024, discounts were 10% of total income, whereas in 2025, they're 4% of total income. So that could be a positive thing. It could mean that we're discounting less. Another point is, let's look at, do we have returns here? Sure, returns, row 14. In 2024, we had, was that 18% returns? Yep, and in 2025, so that's good. So we're getting our return rate down.
When we mentioned the erosion to the margin, one of the possibilities was the change in the channel mix, and one thing that wholesale increased by 7%.
Right. Which has a lower gross margin than just selling direct to a consumer. So this is, if you're in food and beverage, if you're selling to Hannaford's, you're likely getting a much lower price per unit from the grocery store than you would if you were to open up a retail location and sell it yourself or sell it online. But you may choose to do that to chase volume, to get exposure in front of more customers, for a multitude of other reasons. So the one thing we'll say about the ratio analysis is that you may choose to set the denominator to be a different row than total income. So if we're looking at returns are 95% of the time going to come from your direct to consumer or your retail in this business example. And so you may want to take out wholesale. You may not want to include wholesale in the denominator when looking at that, and you might want to control for that. And you can see actually when Veronica did do that, the returns flipped. The return rate has actually gone up from 24 to 25. So that's an important little caveat, but it should match, what works for your business. Okay. So let's keep rolling here. Let's actually switch. Let's go look at the presentation slide where we've done a little more cleanup here. Okay. So, all right. So in this presentation version, as you can see, it looks visually like we've done a lot. Most of it's really just formatting. One thing that we didn't talk about on that prior slide is just the power of grouping. Less is more. It's when you are just hit with a wall of numbers, there's so much to digest and consume that you can lose the forest between the trees. And so what we love to do is just start grouping and hiding things, right? It's very simple on Excel, these little plus buttons over on the left here. We're grouping and hiding rows. Sure, you may want to drill into income, but to be able in one shot to see from income, gross profit, your OPEX, and then all the way down to your operating income, that's powerful. That's what we like to see. So that's one piece here. Let's see, what do we have for time? Veronica, would you talk maybe a little bit about the period analysis, so month over month and year over year?
Yeah, so here we have, I'm just going to open this up a little bit. So in column AM, we have June month over month. So what this looks at is June over May. So we can see Shopify sales have increased by 11% month over month. And one thing we didn't do earlier, but would be interesting to look at, is the seasonality. So seeing what percent of the sales happen during each month of the year. And so maybe if we're a highly seasonal business, this is expected, right? We know that we have more sales during the summer, so it makes sense that there's going to be a spike in sales in June. And then there's the monthly year over year analysis, which looks at June of this year over June of last year. And when we look at this instead, we see that there's been a decrease in sales year over year. So we look at these two metrics to analyze over just how we're doing versus previously in this year, and then also historically year over year.
Great. Okay. I want to talk a little bit about the idea of a doctor's office. So when we go to a doctor's office, we may sit down and the doctor will say, okay, what's the problem? Where's the pain? And you might say, oh, well, my arm hurts. And then they say, okay, well, let me look at your arm. And then they start poking and they press and they say, oh, does it hurt here? And you say, no. He says, does it hurt here? You say, no. He says, does it hurt here? And you say, yes. And then they go and they start honing in, right? And they keep getting closer and closer and closer until they see where the pain is, and they ask a bunch of questions, and then they diagnose, right? And so that's a similar idea for how we want to approach our business. And these financial statements are in some ways the tools to take that same top-down approach. And so let's do an example. And in that same idea, the doctor doesn't go from the bottom up. It doesn't start testing every single finger, right? It says, okay, where's the pain? It's you're having pain. Yes. Okay, where is it? You think it's your arm, right? And goes from there. So let's start big picture. So let's collapse, Veronica, the income section. And let's look at operating income. Let's see, where has the pain been? So if we start in June and work backwards, okay, we see positive numbers, great, no pain. And then, February and January, that's some pain, right? Negative profits or negative operating income in this case is not what you want to see, obviously, for your business. So, okay, let's unpack that. Let's go to the next big picture percentages here. Let's go start with gross margin, actually. Is there a problem with gross profit margin? Well, not really. It's fairly uniform across the board. So that gives some hint that, sorry, am I coming through double? No? Okay. So that gives some hint that the pain is not necessarily due to a percentage, but let's look at the absolute values. Let's just look at the gross profit, the dollar amounts in row 44. We, in June, were doing $430K in gross profit. And in January and February, we did 87 and 172. Okay. So now we're starting to isolate where some of the pain could be coming from. So so now we're going to drill a little bit deeper. So now let's scroll up and let's go and look at income. So right there, there is clearly some seasonality to this business, right? This is a low sales period of the year. The dollar amounts in that row, 25 that Veronica's highlighting, are much lower in January and February. So even if your margin is good, it's hard to cover overhead because your gross profit will be low. the gross profit, just the dollar amount won't be as big as the other months. So let's drill in. I mean, we've assumed that it's just the overall business sales are lower, but let's go ahead and click into the plus sign. Let's go into income here. So we can see in our bigger categories, we've got some coloration here. Shopify sales are down, but returns are still fairly high, but it's kind of hard to tell just looking at these dollar amounts. So let's use some of these KPI that we put in row 28 through 31. So Veronica, can you explain a little bit about discount percent and return percent here?
Absolutely.
Just what those formulas are.
So discount percent takes the discounts given row, so row 15 divided by the sales, the online sales only, because usually discounts are related to what we're selling online. And then returns are also doing returns over the sales online for that period. So what we can see here is in January, we had a massive return percent, which we can get into. This is, what we would normally think this is due to is that there's usually a lag in returns. Returns usually show up a month after when the things were sold. So after holidays and high sales periods like Black Friday and Christmas, it's not so uncommon to see high returns in the following months.
And if you were running perfect accrual, you could be accruing for your returns. And so you could have a balance sheet account where you essentially recognize what the returns will likely be when you're having those peak sales so that you don't see these big spikes. But on a cash basis, you do feel that pain later because the sale gets reversed when the product gets returned. And then the discount, so if you're doing low sales in a period, that's a good time if you want to generate some cash to get rid of old product, to run a big discount campaign. And so you can see that maybe this business did a big discount effort in a period of low sales to try and generate some cash. So both of those things hurt your gross profit. And overall, it's a lower period of sales for the business. And as you go down, you can do your best to reduce your OPEX, your operating expenses during those periods. But, if you want to keep great talent, you gotta, have people on salary and you keep them throughout the year, right? So some of these costs are unavoidable and you need them to keep a great team or pay for your rent, for your retail space. In this example, potentially year round. So some of those operating expenses are unavoidable. And so when we don't have enough sales to cover that, we run a loss. But if you're modeling and you have a good pulse on your business and you understand the seasonality as an owner or as an investor in this business, you can feel the comfort that, sales are going to return. This is a seasonal business and that we're going to make that money back. But you might need a plan for your cash. And so let's keep moving. Let's get to the balance sheet so we can hopefully get a little bit of time for cash at the end here too.
All right.
Okay. So let's just dive right in. A big, messy statement. Lots of different rows here, lots of different months. I think rather than doing all of the cleanup together, let's just jump to the cleaned version, the presentation version. Okay, great. And so we've just done similar idea here, collapsed a lot of the rows. Would you give a couple more clicks in, please, Veronica? Just to zoom. Let's get a little more. Great, thank you. Okay, so let's just put ourselves back to the formulas we talked about earlier. The balance sheet must balance, as in the total assets must match the total liabilities plus the equity. Okay, and so in this case, even though this is a dummy example, this must be off by a penny. But these are redacted books. But anyways, as you can see, the dollar amount, these match. And let's just unpack what's on the balance sheet. This again is a snapshot of time. So instead of a date range, this is run, each column is on a given date, presumably at the very end of that day. So June 30th, that is, $550,000 is how much cash we had on June 30th. Okay. AR, what our customers owe us, accounts receivable, $397,000 on June 30th. Our inventory. So let's say that we did a count every single month. We had $2 million in landed cost in inventory on hand at that given time, or maybe in transit too, I forgot, is in the example. Okay, so that's inventory. And then fixed assets. This is a business that doesn't have a lot of fixed assets, but maybe you got a big piece of equipment or something like that. And then let's get down to the liabilities and equity here. So AP, that's what you owe others. So it's kind of the opposite. I think about it as the opposite of AR. So maybe you have a piece of software and the software company is super nice and lets you pay at the end of the month instead of the beginning. Okay, so that's AP, line of credit, that's a type of debt. You've got your credit card bills, the credit card outstanding, longer term liabilities. Maybe you have a chunkier SBA loan, some fixed term debt, and then we get down to the equity, which for the most part is what you as an owner have contributed / drawn from the business and the retained earnings of the business. So that's a connection over to the income statement. So a lot of the same analyses apply, right? We can do a month over month analysis. We can do year over year. We can see how our cash position has changed. That's really important. We can look at just on a dollar basis too, rather than just percentages. Just being careful with time here. So this is the balance sheet. I would take that same kind of diagnostic approach where you're looking at the big picture numbers like, okay, is my cash down? Well, all right, well, let's drill into cash and let's open up that cash account and see, is it in specific accounts? Are we drawing less on our loan? Are we having less profits? We would see that in the equity and try and understand this business a little better. Let's get to KPI real quick. So there are many different ratios and KPIs that you can pull, especially on the balance sheet. Banks think a lot about this. But so your current ratio, that's a measure of liquidity. So that's comparing your current assets to your current liabilities. And that's assessing your liquidity, your ability to pay off your short-term debts. Another one is the quick ratio. I think it's also nicknamed the acid test. But you would take inventory out because if you needed to pay off a huge bill or pay a vendor, you might not be able to sell all your inventory in 2 days to go ahead and fund that. So there are different ratios, and these ratios have rough ranges of what's healthy. But it really it varies industry to industry and business to business. Okay, inventory turns. If you have inventory in your business, you want to turn through it quickly. So this could be a business that has like is in luxury goods or something like that, where inventory does not turn particularly quickly. Even a 1 is somewhat low. It could be that you have a significant amount of dead stock and you need to deal with that. On the other end of the scale of 15, that could be like a grocery store turning through inventory really quick. And then your debt to equity, this is a measure, I think about it of how much skin you have in the game. You know, the liabilities could be a lot of bank debt, and the bank may say, well, you know, we're putting a lot of money in, but on the equity side, we don't see ownership putting as much money in. And that's a very kind of broad example of that, but that's a solvency or a leverage metric. So, okay, so let's take a breath here and so we can make sure we have time for questions at the end. Let's go back to the presentation. If we could, Riley, thank you. So we got through that. We want to take just 2 minutes on cash here, and then we'll save questions for the end. So profits do not equal cash. This is a very common misconception. You can be a business that is profitable, and like Veronica said earlier, you can be running out of cash. You can be on an accrual basis showing profits, but if you're growing really quickly, for example, and you have inventory, you likely need to buy that inventory before you sell it. And in that case, you might have to put cash up front to then make your profit or your money back later. But sorry, you may be showing your profit today on a margin basis, but from cash, things are getting tight. So that's why it's important to project cash, okay? Veronica, I think we might skip this one. This is just a nuance of there's the cash flows that come out of QuickBooks or your financial software, and then there's operational cash flows where you look forward and project your cash, and those are different. On the left, that might look like something coming out of your financial software that's been reported a bit more effectively, but then on the right, operationally, you might have your historicals, the actuals, and then your projected. You may project cash going forward.
I think, sorry, really quickly, just the key is that the financial cash flows are basically a report card for your business's cash performance. It does not help you with your day-to-day decisions. That's where operational cash flows comes in. Go ahead.
All right, this is kind of a silly slide, but think about your cash like a pool. The pool is your bank account, how much cash you have in it. And if you want to fill your pool up, you can do one of two things. You can make water flow into it. You can receive money more quickly, or you can stop the leaking, slow down the leaking, right? And if you want to preserve your cash, you do both, or increase your cash. So, all right, big eye chart, a lot of tactics here. So look, I'll just do these really quick, but pay slower, collect faster, right? Go to look at your AR, see which customers are late on paying, get them to pay. Go to your AP, see which vendors you can renegotiate with, so pay slower. Do the discretionary things first, obviously, pay your people. Get your suppliers to push back shipments, especially if you have too much inventory. You can borrow, right? Just make sure that you think about the covenants, the collateral, and then really double check to see if there are any personal guarantees. That's really important. Credit card, you can stop paying your credit card. That's expensive debt. It's probably better to borrow before you do that. But you can move to terms. And then on the asset side, go to your customers, collect what you're owed. Raise your prices. Be careful with this, because if you do it too fast, you could slow down your overall sales, which could be a negative impact to cash. You could run a big discount or prompt for prepayment. Figure out just ways to move your inventory. Sitting inventory on your books is not good. That's when you see like a low turn, like that business example we just showed. Lease instead of buying, so on and so forth.
And I would say really quickly here that we did see an example of inventory moving for cash purposes earlier. We just weren't able to drill into it as much. So in February, when we saw the massive discounts that were 25%, and the higher sales, but we had a bad margin at the bottom, that was because they did a flash sale. They wanted to move inventory. So they discounted a lot of their losers in their inventory to sell more of it. And it generated a lot of cash, except on the profit and loss statement, because they sold it at a big discount. It showed loss due to margins.
That's right. Okay, and the reason we're kind of blowing through cash is that we have done a separate full webinar just on cash flow with a very deep dive into the modeling of it. We spend a lot more time on that tactics page. And so I think you'll get this presentation, but if not, if you just Google it, it's on YouTube, it's on our website. So go ahead and check that out. Okay, take a breath. Let's have some questions. Rachel?
Hello. I was waiting to appear. Thank you so much, guys. That's just, I could have honestly, I think we needed 2 hours, but I hope everyone who was here, who joined us this morning, at least got a taste, and you diving into those worksheets just, I think people don't want to ask for help, but everyone needs help. So really breaking it down for us was very helpful. We do have a couple of questions. One you sort of referenced, but can we get a copy of your presentation, the balance and P&L sheets following today's presentation? So the chamber will be following up with a copy of your presentation, but I wonder, do you feel comfortable sharing those worksheets?
I think we're going to keep the worksheets. As I said, those are redacted. It's a fake business. I'd rather keep those. But there's a wealth of knowledge. Everything that we just did is out on YouTube. You could give it a Google. There will be a bunch of different polished, probably more polished even than that, spreadsheets that you can go and grab.
Great. Thank you. Yeah. And your contact information is right up on screen too right now. So if anyone wants to follow up with you to continue the conversation, they can do so that way too. And everyone will be sent a link as well to the recording. So if you need to refer back to this, you can, and then you can find your other presentations as well online. But I think we have one more question here. Our Legier Design says, where is the best place to start this more formal analysis for a business that's just getting started?
Best place to start. Well, I'd say if you have some comfort with Excel, I would do it yourself. It can seem like a wall of numbers and a little bit overwhelming, but if it were me, the first thing I would do is go and just kind of do what we did in this presentation today. I would export the information. I'd start with some very basic, just sum up the years, maybe do a little ratio analysis, and start to diagnose, right? Trust your judgment. If you, a lot of people may say, oh, I'm not a numbers person, right? But if you look at something and you look across a row and you see a number was always one thing and then it jumps up and it's double, okay, ask questions and don't be afraid to ask what feels like a silly question, because 9 times out of 10, it's not. 9 times out of 10, your intuition, you know your business, right? And as you start playing around with the numbers, it's going to give you a whole new level of confidence and understanding of your business. So that's where I'd start.
I know it's kind of a vast question to ask, but I think numbers are intimidating and they block a lot of people from actually getting started, to be honest, the fear there.
Sure.
So having people such as yourselves who are industry experts, who are happy to offer their time and expertise is invaluable. So thank you for everything that you guys do. And thank you for presenting this morning.
Of course, thank you for having us.
Yeah, this was a treat. Thank you very much. Thanks you all for tuning in. Thank you, Rachel. Thanks, Riley. Thanks to the Portland Chamber. And we're on Exchange Street. So if you want to stop by and have a coffee, feel free to reach out. We'd love to meet and say hi.
Yeah, and we're an email away. So if you have follow-up questions, feel free to just email either of us and we'll be happy to answer and help out.
Wonderful. That's what I love to hear. Well, thank you both again for today's presentation, and thank you for carefully answering our questions this morning. And of course, I'm sure you may have heard Steve and Veronica referring to Riley Legier, my colleague. Thank you for helping to produce yet another successful virtual event here at the Chamber. And last but not least, thank you again to everyone watching, everyone who engaged with us this morning. As we mentioned earlier, if you're interested in continuing the conversation with Steve and Veronica, make sure to check your email for a follow-up message with links to additional resources, the presentation, contact information, etc. Additionally, as I mentioned before, this will be available on the Chamber's YouTube channel for free replay, and you are more than happy. We'd be pleased if you shared it, and of course reached out to Steve and Veronica. If you're interested in presenting at Growth Basics for Business or know of an industry professional who may be interested, please visit our website at portlandregion.com and submit a proposal. Any questions? My information, Riley's information, the rest of our team's contact information can be found there as well. So with that, again, thank you so much for attending this morning. We'll see you on October 17th right here on Growth Basics for Business. Have a lovely day, everyone.